What's up, wealth creators? Matty Ice here. Welcome to another video. We're going to have some fun today talking about IUL. It's always my favorite topic. And we're going to do a video review, YouTube video I saw the other day, where this gentleman is comparing whole life insurance versus IUL and which one is better. It's about a 4.5-minute video, not too long. But you know, this is really frustrating stuff for me. And quite frankly, I'm getting a little tired of it because you can't compare whole life insurance and IUL. You just can't. It's like comparing apples and tater tots. Okay, they're just not anywhere close to the same thing. If you're going to compare anything to whole life insurance, it needs to be savings accounts, bond alternatives, things like that. And if you're going to compare IULs to something, it's going to be 401ks, IRAs, because those things are invested in the market. IUL is invested with using call options, whatever. But the performance of those assets is dependent on the stock market index. Okay. Whole life insurance is not, has nothing to do with the stock market. Okay. So this comparison is really stupid, number one. And number two, the reason I wanted to, I do these video reviews is because I just think this is really dangerous information and it's very misleading. Okay. And we're going to go through it. I want to address a couple of the more concerning things that this gentleman says, because at the end of the day, this is what I want for you guys. This is why I started this channel. I want you to have all the information and all the facts so you can make the best decision for you, whether that's whole life insurance, whether it's IUL, whether it's neither, whether it's buy term and invest the difference. I don't care. You have to have all the information and facts, though, in order to make the best decision for yourself. And when these agents talk about upside potential, downside protection, you can average. I looked on this guy's website. It said you could get an average of 12% annual compound growth, depending on how you structure it, or like, who knows? I have no idea what he's talking about. And I have no idea where he gets those numbers from and how that's even legal to tell somebody, to even suggest. My biggest problem with IUL is how it's illustrated, presented, and sold to the public. Okay. They never talk about any of the massive risks involved with IUL later on as you get older. It's not really in the beginning of the policy, but when you get older and your cost of insurance is going up every single year and you're taking income, you're not making premium payments anymore, you have a few down years, you're in a lot of trouble, guys. They brush over that like it's impossible to happen. And then where the conversation ends for me with IUL, and we're going to address that in this video, is when they illustrate 6-7% growth every single year uninterrupted. Guys, do you really believe the market is going to credit you 7% every single year uninterrupted? And to really hammer this point home, I'm going to drop a link down in the description to another training I did about the difference between average rate of return and actual rate of return, and why average rates of return used on an illustration for financial projections is a complete scam. It's so misleading. Please make sure you watch that video. It's in my Infinite Banking University. You can check all that out down below too. But look, I want you guys to be safe. I want you to make the right decisions for you. I almost bought one of these IUL products. I am so glad I didn't, because now that I understand how these things work, man, are they dangerous, man. And most of them are not set up properly. And if this isn't enough, make sure you get this book too. It's called Lapsed by Elon Moaz. All right. Goes into so much detail about how these things work and the risk associated with it. I just want you guys to be safe. At the end of this video, I'm also going to present to you an alternative to IUL that virtually makes IUL completely pointless. There's literally, I just can't think of any reason why anybody would ever buy an IUL when this alternative is available. All right, so stick with me to the end on this. It's going to be really, really important for me anyways, like to make sure that you have the information and you know what your options are, so you know which direction you want to go. All right, so let's get into it. Here we go. All right, Curtis, dazzle me.
Whole life insurance, is it the best place for your hard-earned money? Based on my research, it's not likely. Whole life made sense 40 years ago due to high guarantees and unique benefits, but now I view it as an outdated, providing very little value compared to alternative life insurance contracts.
So first off, when he says very little value, that's just stupid. I'm sorry. There are so many benefits to these cash value whole life insurance policies when you set them up right. Like, it's just insane. I go through it in my Infinite Banking Masterclass. You guys can check it out if you want. It's in the description. There's so much value you get out of this. And when you set this stuff up properly and you implement infinite banking in your life correctly, man, it's just the most powerful financial strategy I've ever seen. but like to say that these things have very little value, what he's doing is comparing rates of return, even though his rates of return on these IULs are false. Like it's pie in the sky. Okay. But we don't set these policies up strictly for rates of return. Okay. Again, you're comparing apples and tater tots. Okay. With stock market products versus permanent life insurance contracts. Again, if we did a comparison, whole life savings, IUL, 401k, because they're both they're both dependent on the market, right? So on an illustration, if you compare an IUL and a whole life illustration, IUL is going to look really, really good because of those rates of return. So when he's talking about value, he's just talking about rates of return. So just keep that in mind. The internal rate of return of these contracts, it's a really good bonus, in my opinion, where your money's going to continue to grow while you use it to build wealth elsewhere. And it's going to grow. It's going to get true uninterrupted compound growth at 4 to 5% tax-free for the rest of your life in a whole life insurance policy. Now, is that as good as 10%, 12% in the market, 30% in the market? No, but we're not chasing rate of return here when we're using these whole life insurance policies. I really want you guys to understand that. Okay, it's a really, really important component.
1980s, whole life insurance might have paid up to 20% returns through dividends because of an unusually high interest rate environment.
No, the highest I ever saw was 14% dividends. It was, high interest rate environment, inflation was out of control, whatever. Pretty sure it was only 14% though. But, he's talking about like the dividends and stuff coming down. Well, cap rates and all that stuff have come down for IULs. The rates for universal life policies, which are just completely blowing up. Where they were illustrated at 8, 9, 10, 12%, whatever, and now they're paying 4%. Yeah. So everything has come down with that. So he's bashing whole life on this, but the cap rates and participation rates for IUL have come down too. So I don't know what you're talking about.
Now the max dividend is typically below 6% before fees and cost of insurance. Why is it so low? Insurance contracts are typically built with security as focus and not growth potential. Because there's very little potential to produce good compound interest, to use these plans as your own bank or for retirement income make very little sense.
However, that's not true. That's just not true at all. You plug in, look, it depends on how you fund your policy, but you plug in whatever amount, I front loaded my first policy with 120K. You put that at 4 or 5% compound growth. Not even including the premiums that I continue to put into it. What that looks like over the next 30, 40, 50 years, it's pretty good. Are we going to get super wealthy with something like that? No. But there's so much we can do with our policy, and that's where we build. That's where we build true wealth with it. So, yeah.
Some insurance agents push whole life onto the public as a good alternative due to high commissions and the ability for guaranteed results, even if the results are below average.
Oh, he did not just go there. Oh, let's have some fun with this, boys. Okay. So commissions. Yeah. You know what? I make commissions when I help people with these policies. But do you know how much more commission IUL agents make? You're talking some contracts for IULs, again, depending on how they set them up, which most of the time they're set up like crap, which pays the highest commission. They can get like up to 165% on the first annual premium. Like it's insane. The way we structure policies for max cash value, look, everybody's different on, how they need their policy design, but we lower the base premium and increase the paid up additions, which maximizes cash value. That lowers our commission. So when I design a policy for somebody, I'm actually taking money out of my pocket to make sure that it's structured properly for them. So, dude, again, he's telling one half of the story here. And it's not even a really good story. It's completely inaccurate. Yeah, of course there's commissions involved. We have to eat too. We got to put food on the table. But IUL agents make way more in commissions selling a fundamentally flawed product that will most likely blow up in people's face when they need it the most. So, nice try.
Let's compare the features and benefits, projected returns, and retirement income over a 30-year period between a whole life insurance policy and the MPI Secure Compound Interest Account, what I consider the IUL 2.0. Whole life is a permanent life insurance.
Okay, wait a minute. Again, man, he's pulling out a lot of really, really interesting stuff here. Okay, so here's the first thing: is this MPI Secure Compound Interest Account, guys? It's an IUL. Okay. Don't think this is something special that he's created and made that nobody else knows about. Okay. It's an IUL. And you just say it's IUL 2.0, whatever that means. Okay. But when they change the name of something like this, it's a marketing tactic to create like a unique selling proposition to just kind of stand out from the competition, whatever. It's an IUL. Okay. Number one. Number two, I want to break down this. What is it? This name right here, this thing that he calls the IUL, secure compound interest account. Okay. Number one, there is nothing secure about IUL. It's built on annual renewable term. Your cost of insurance increases every single year, exponentially as you get older. And the argument will be, oh, well, your net amount at risk is low. Okay, maybe that's the case sometimes. But what happens in down years? You're not making premium payments anymore. You're a lot older, and you get 0 years. You don't get any credit on a particular year. Where's all the cost for the interest and the cost of insurance and all that stuff? Where does that come from? It comes from the cash value. Your cash value goes down. Your net amount of risk skyrockets. The next year, it's even worse, especially if you have 2 down years, 0 years in a row. Oh man, you better go to church that Sunday and pray to God because that thing, it's in a downward spiral at that point. So there's nothing secure about IUL. There's too many factors that can change: participation rates, cap rates, how many 0 years are going to have, the fact that it's illustrating compound growth every single year. Like, there's nothing secure about it if there is a high risk of the policy lapsing. Number one. The second part of this this account that he's talking about, compound interest. I don't want to beat a dead horse here, but I really want to hit this point home for you. You don't get uninterrupted compound interest in an IUL as they show you on an illustration. When they show 6 point whatever percent or 7% every single year, when you plug that into a compound interest calculator, yeah, it looks really good. But this is based on call options and stock market index. You're not going to get that every year. I don't care what average rate of return you think you're going to get. Okay. I don't even know how you think you can get an average rate of return of 7% every year when your cap is 12%. I'm pretty sure that's mathematically impossible, but what do I know? Especially when you take in all the cost of insurance. But don't be fooled by this, by like when something is based on stock market performance that you're going to get true uninterrupted compound interest. Yeah, not so much, guys. And then account. Again, like, language is so important here. This is not an account. You're not going down to your local credit union and opening up an account. Okay? That's backed up by FDIC. Well, the credit union is different, but you get what I'm saying. This is a life insurance contract. All right? These words mean things, guys. And it can be very misleading when someone hears compound interest account and then they don't know anything about cost of insurance, net amount at risk, how those two things work together, what happens when I get a 0 year, what are all these surrender charges. Like, that's very, very misleading, guys. All right, so please don't be fooled by this stuff.
Insurance contract with many features and benefits similar to the MPI IUL 2.0 policy, but also some deficiencies when used as a retirement plan. Some of these features and benefits include guaranteed life insurance paid out to the beneficiary, living benefits, 100% tax-free distributions, liquidity with no access penalty of cash value at any age for any reason, and a guaranteed dividend typically around 3 to 4% minimum before expenses.
Nope. Again, language, guys. Okay, most of this was correct. Here, let's go back. Permanent life insurance contract, that is correct. Guaranteed life insurance payout. We do have living benefits. 100% tax-free distributions when it's set up correctly. Now, one other thing too is, like, we're not setting these things up purely for tax-free retirement income. Can it be used for that? Of course. All right. But it's, again, we're not usually setting policies up just for that. It's not the only benefit. All right. So just keep that in mind. Liquidity with no penalties. I mean, you pay interest on, policy loans, just like you would, with an IUL, whatever. Guaranteed dividend. Dividends are not guaranteed in a whole life insurance policy. There is a guaranteed component, guaranteed growth rate. The company that I'm setting up my next policy with right now, guaranteed rate of 3.25%. Compared to a savings account, I think that's pretty good because it's going to grow tax-free. It's going to get true uninterrupted compound growth. I get all of these other benefits from the policy that you can learn about in my masterclass. Okay. Plus, I get the dividend. Now, dividends are not guaranteed. Okay. With that said, these companies have never missed a dividend. A lot of them haven't. The ones we work with. The first one I got my policy with, 119 years in a row, they paid a dividend. So through all the financial chaos throughout the last 100 years, they paid a dividend every year. The next company I'm working with, 146 years in a row, they paid a dividend. So I'm pretty confident they're going to pay a dividend, but it's not guaranteed. Language is important here, guys.
MPI is an indexed universal life insurance contract using increasing death benefit with many of the same features and benefits, but also enhancements to provide potentially much better retirement income. Some of the MPI features and benefits include guaranteed life insurance paid to the beneficiary, living benefits, 100% tax-free distributions, liquidity with no access penalty of cash value at any age for any reason, but rather than a low guaranteed dividend such as whole life, an MPI policy credits interest against the S&P 500 index with a guaranteed floor of 0% when the index loses value and a cap approximately around 10%.
Okay. So I have a problem when people say that there's a guaranteed death benefit payout on a term product. Guys, if you don't know the difference between whole life insurance and term life insurance, you need to start there, because IULs are built on annual renewable term insurance, which goes up every single year, which can expire, which means, or in this case, lapse the policy if the policy cannot keep up with the cost of insurance when you get older, or you can't make a $40,000 payment or $20,000 payment, whatever the cost of insurance is that year to avoid lapsing the policy. There is no guaranteed payout at that point. If the policy lapses, nothing gets paid out. You lose everything that you put into the policy, plus you get a massive tax bill for any gain. Credits against the S&P 500, that is the case. 10% cap rate, whatever. All that's, again, I hate this. Secure compound interest account is so dumb.
Your annual returns of 6 to 8% on average historically.
Okay. Again, guys, watch my training on the difference between average rate of return and actual rate of return, and how when you use average rate of return in these illustrations for IULs, it is so misleading. It is not going to happen.
This method can increase returns over a whole life policy by taking advantage of the stock market growth potential and maintaining a 0% security feature.
Okay. And like I said, guys, wait till the end where I show you how you can get that with a whole life product. So none of the risk of IUL, no cap rates, no participation rates, no rising cost of insurance, guaranteed floor of 3.25% instead of 0. Okay. And you get upside potential in the market. Stick with me to the end. I'll show it to you once this video is done.
In addition, by accessing the participating insurance loan feature against the cash value at 4% currently, which we call the MPI relock, and contributing the additional capital back into the policy as increased premiums, the strategy can enhance growth potential up to 15%.
Okay, whatever. I want to check the date when this was. Okay, so this was 2 years ago. He's talking about 4% for the participating loan rate. It's, I mean, interest rates have gone up pretty significantly. The typical loan rate for life insurance companies right now is between like 5.5% to 6%, give or take, 5 to 6%. So that can make a very big difference on this strategy that he's talking about. Okay, he's talking about the arbitrage of borrowing at 4%, but your account's going to, your cash value is going to get credited every year at 6.4% or whatever he said. Not going to happen. What happens when you are on the hook for that 4% and you have a loan balance of $500,000, $1 million, whatever? Because the amount of income he's going to show you that you can take here in a minute is, I don't even know how it's legal. Okay. But if you get up to $1 million loan balance, you have 4% interest and you don't get that 6% credit that year, plus you have the cost of insurance that needs to be covered. Where does that come from, guys? Comes from the cash. So when they say you can't lose money in an IUL, you can't lose it in the market, but you can absolutely lose money in an IUL in these down years. And who cares how we lose the money? It's the fact that we do lose the money, and you're saying that we can't. That's ridiculous.
Because an MPI life insurance policy offers interest credit against the index instead of contractual dividend. Whole life could be considered a little bit more secure, as there may be years MPI receives no interest and still has basic expenses. But that little extra security in the form of a guaranteed low dividend can drastically impede your cash value growth and retirement distribution potential. Let's do the math. Consider a 35-year-old setting aside $10,000 a year into both the MPI and whole life contracts. After 30 years of growth, whole life is projected to have around $600,000 in cash value after a total contribution of $300,000. That is barely enough to keep up with basic inflation, providing minimal increased wealth. With an MPI, with the same $300,000 contribution, the projected cash value is around 1.5 million.
Oh, projected growth. And look at this right here at the bottom, guys. Results calculated based on a 6.4% growth and assumed 4% relock loan rate. Okay, well, I just told you that the loan rate is between like 5.5% and 6% right now. And you're not going to get 6.4% every single year credited. So are we really going to have $1.5 million at the end of 30 years? Probably not. And what if the policy lapses? You're not going to have anything. So this is what IUL agents do when they try and compare whole life and IUL. They rely on the illustration to make the IUL look so much better. But what is going to happen in reality? Not fantasy land. Okay, reality. I'll take the 600,000 option, knowing that it will be there, guaranteed, with whole life, versus rolling the dice with an IUL. Potentially, I can get 1.5 million. Whatever, man.
But more importantly, how much retirement income can each produce? Whole life, with their guaranteed dividend, will reliably generate around $30,000 of annual income, while MPI can produce up to $150,000 per year.
Really? You guys, like this, dude? This take, I don't know how. I just don't know how this is legal. He is proposing that you take 10% income from this policy every single year. And you know why he can say that is because on the illustration it shows uninterrupted growth every single year, like crediting every single year. If you are taking $150,000 in income every single year, and you have a couple of down years as you get older, and you're not making premium payments anymore, you exponentially increase the chances of this policy lapsing, and then you have nothing but a massive tax bill. And all of the income you thought you were going to get, and like, man, this is what really makes my blood boil, guys, because it scares me to think that there's people out there that are going to hit 70, 75, 80 years old, and they're relying on this illustration, this concept that I'm going to be able to take $150,000 per year after putting only 10,000 in every year for 30 years. And I can do that for the rest of my life. And then at 75, 80, all of a sudden I have to turn on my overloan protection rider because I have hardly any cash value left. Well, where's the rest of the income? I thought I was going to get this until I was 95, 100 years old. Not to mention the next year, or the next time you have a 0 year and you don't get credits, and now you're 80 years old, your cost of insurance is huge. It's massive. And your cash value you don't have enough cash value to cover that. Lapse. Done. You're toast. It's gone. That is the risk of these things, guys. And man, he's talking about $150,000 of annual income. I'm sorry, guys. I don't know what else to tell you to open your eyes to see. Like, I mean, this is just so misleading. This is so stupid. I don't know how it's legal.
A 250% projected increase in cash value, but most importantly, a 500% projected increase in potential retirement income, all the while providing great
potential retirement income, security with growth. Yeah, IULs are real secure. Guys, if I told you that you could get 500% more muscle mass by taking just a crap load of steroids, look at this amazing. And actually, you know what? I'll give it a fancy name too. I won't call it a steroid. I'll call it human growth injection, human growth potential, whatever supplement. Okay, but it's a steroid. Okay, and you can get 500% more muscle growth and muscle mass versus just eating right, maybe taking a couple of health supplements, whatever, getting in the gym, etc. Which would you do? Right? It's the same concept. That's what we're talking about here, and it's just 500% increase in retirement income. Yeah, when you see that, it looks really cool and it piques your interest. But is it real? No.
Great security against stock market downturn and growth potential above the stock market.
Yeah.
Some also use the whole life contract for a system called infinite banking, or bank on yourself, which can produce even worse results than the whole life contract alone. Infinite banking might be the worst compound concept ever designed.
Wow.
I have another video breaking down infinite banking and just how bad it really is inside today's whole life contract.
Nice. Oh, that's going to be the next video. I'm going to go ahead and wrap up here too, because this one, he's almost done here. That is going to be fun. I can't wait to watch that video, because infinite banking, when these policies are set up right and the strategy is implemented correctly, it's just the most powerful financial strategy I have ever discovered. And I'm implementing it in my own life right now. And, that's another thing too. I believe in leading by example, guys. This is not me, like you said, trying to make commissions, whatever. Yeah, I'll make commissions if I set your policy up. I'm not going to hide behind that. Hopefully you're okay with me making money, just like I'm okay with you making money with whatever you do, unless you're selling IUL. Okay. But infinite banking is really, really powerful when implemented correctly. I can't wait to watch that video. Make sure you guys subscribe to the channel, because I'm absolutely going to check that out. And I will, once I do that video, I will put the link to it in the description. Check it out, because infinite banking is awesome. Now, with that said, I want to pull up a quick Google Slides here really quick. All right. And I promised you that I would share with you an alternative to IUL that allows you to get that upside potential, downside protection, but not even just a zero floor, a 3.25% guaranteed floor, without all of the risks of IUL. Okay. And if by the end of this, you still don't see the point of IUL, like I don't know what else to tell you. But here's the thing. There's a couple of questions I want to ask. I want you to ask yourself, if you are considering an IUL, can you explain the difference between cost of insurance and net amount at risk, and what the relationship is between the two? If you can't do that, you need to do more research, okay? Because this is a major component of IUL policies, that if you don't understand how these things work, like this is one of the main aspects of all the risk in IUL. And then when you put income on top of it, right, it can get really dangerous. Do you believe in an eternal bull market? You really believe when an IUL agent tells you you're going to get 6 to 7% every single year, uninterrupted, tax-free? Do you really believe that? And this is a product that's based on the performance of call options in the stock market. Good. Well, I mean, if you believe it, then and you understand how these work, go get one. I don't care. Just have all the facts, have all the information. So why buy an IUL? We can get almost the same exact benefit without the risk. Did you know there is a life insurance product, a whole life insurance product, that offers upside potential without the downside risk in the market, just like an IUL, but it's guaranteed to grow at 3.25% every year for life, even when you have a 0 year? That does exist, guys. And that's why I just don't know why anybody, when you know this exists, why anybody would get an IUL, right? So here's how it works. There's not many companies that do this either, especially the way that this company does. It's the only one that I'm aware of. It's awesome. It's how I'm setting up my next policy. Guaranteed 3.25% no matter what. It's like a savings account on steroids, guys. All right. Contractually guaranteed, grows tax-free. You get tax-free access as long as you structure and utilize it properly, etc. Here's how it works. Dividends are used to purchase call options on the S&P. Side note, if you don't know how options work, you also don't have any business buying an IUL. All right. Because that's how it works. So what they do is instead of crediting your dividend to your cash value that you would normally get, and IULs do this too. This is the same exact thing that IULs do. Instead they take that dividend and they purchase call options on the S&P or whatever index you choose. In this case, it's the S&P. All right. And that's why you get you don't lose money technically in the stock market when the stock market goes down, because you're not technically invested in the market. You have these call options, and if the market goes down, the call options just expire worthless, so you lost your dividend. That's it. Okay. Now, here's another thing I love about this. It's really, really simple. Here's how it works. If the crediting works, if the S&P goes up 5%, you receive whatever your dividend would have been. Whatever they used whatever dividend you would have received that year, that's what you get. If the market goes up 5%, if the market goes down, you just lose your dividend, but you still get the 3.25%. It's contractually guaranteed because this is permanent whole life insurance. If the S&P goes up 10% or more, which in up years, it usually goes up double digits. Sometimes it goes up a single digit, whatever. Most of the time, it's in the double digits. All right. If it goes up 10% or more, you receive double your dividend. That's it. Doesn't matter if it goes up 10%, 12%, 25%. Doesn't matter. It just doubles your dividend. That's how it works. So you get upside potential where you can, if I'm going to get a dividend of $5,000 and the market, and I'm using this indexing strategy, and the market goes up 10% or more, I now get a $10,000 dividend. What if I'm going to get a $25,000 dividend? What if I'm going to get a $50,000 dividend and it doubles? Like, do you see the potential here? I mean, it's pretty sweet. And here's the thing. We don't have to worry about cap rates changing. We don't have to worry about participation rates. No rising cost of insurance, because this is whole life insurance, not annual renewable term, which is what IUL is built on. There's no fees for this indexing strategy. All right. It's not because it's a rider that's included free of charge in the policy. You can use it. You cannot use it. You can also split your dividend in half if you want. If you want to receive, if I'm getting a $5,000 dividend, I can elect to have half of it, so $2,500 credited to my cash value as a dividend. But then I can tell the company to take the other $2,500, put it in this indexing strategy, and see if I can double it. But the worst case scenario is I lose that portion of my dividend, but I still grow by 3.25%, and I still received half my dividend. Right? You get that flexibility, and there's no cost to use that this indexing strategy rider. You also get an overloan protection rider included at no cost. Right? There's no cost to add this rider to the policy, and it basically just makes sure that you don't over leverage your policy. You don't loan too much against it, and you shouldn't be doing that. It'd be very irresponsible. But there is that overloan protection rider in place to make sure that it doesn't lapse. And here's the difference with regards to this rider on a whole life product versus an IUL. Okay. On whole life, we have the safety, protection, guarantees that whole life provides. We don't have the rising cost of insurance because it's permanent life insurance. All right. Everything stays the same other than like the dividends, right? With an IUL, your cost of insurance is going up every single year. Here's what happens. If you ever get to the point that you need to turn on the overloan protection rider, that means you have very little cash value left. Okay. In an IUL, in a whole life, I mean, that sucks, but it's not going to lapse because of the loan. And then it's not going to lapse because of cost of insurance because it's permanent. With IUL, that's not the case. You could turn on an overloan protection rider in an IUL, and it will stop the policy from lapsing due to the loan balance and the interest. But what happens the next year or the year after that when you have another 0 year and you don't get any credit and your cost of insurance is so high now that your cash value can't cover it, you're going to get a bill from the insurance company saying, hey, or basically a notice like, hey, your policy is at risk of lapsing unless you pay this amount, $5,000, $10,000, whatever ridiculous amount it is when you're 80 years old. Okay. So the policy can still lapse because of cost of insurance. Okay. It can't lapse because of the loan interest and the balance, but it could still lapse because of cost of insurance. So what are we doing here, guys? Are we really rolling the dice with our money like this? Are we really rolling the dice with our retirement like this? Like, do we really want to take these risks, especially when there is a fantastic alternative with the protections, guarantees, and security of whole life, and you can still get some upside potential to potentially do better than what's illustrated on the policy, whatever, better than what you would do if you were to just get regular dividends. You can do that if you want, but man, so much safer, so much easier, simpler. We don't have to worry about annual point to point and which index to choose, like these volatility indexes, these multipliers, cap rates, participation rates. Oh my gosh. Like, since when did we want to become a money manager, guys? I don't. That's why I love these whole life insurance products, guys. This is how you do it. So anyways, I hope that was helpful. The point of these videos is to give you guys information, facts, so that you can make the best decision for yourself, to get you to think about these things, start asking questions, do more research, learn, like really understand what you're putting your money into. All right. We're not buying a pair of shoes here. Okay. We're not even buying a car here. We're talking about putting a significant portion of our hard-earned money into a financial product for our future. This is a very big decision that we're making here. So understand what you're getting into, guys, please. And if you understand how IUL works and you still want to do it, fine, do it. Okay. Maybe there's this magical IUL product out there that I haven't heard of yet that actually is fantastic. Probably not, but who knows? Okay. just know what you're getting into, guys. If you have any questions, drop them down in the comments below. I would love to hear your feedback. What do you think about this? What did I miss? Like, what am I missing here? Okay. And if you have any requests for videos, let me know. Make sure you join the community, get the masterclass, all that good stuff. And I will see you in the next one. Hope you guys are crushing it. To your success. Matty Ice is out.